right, so I guess a little background on me. I started investing in real estate 4 years ago. I went to LMU, graduated in 2017, started graduating my senior year in college.
He's 23 years old, by the way. FYI.
24, actually.
Okay, sorry. 24, 23.
I turned 24 in April. 24 years old, started investing back in college. My dad had 40 grand saved up. Started buying properties out of state because we didn't feel like flipping here with 40 grand would make any sense. Because you have to raise the hard money, then you have to raise the gap, and then at the end of the day, you're left with $20,000 profit for yourself. So we thought, all right, where can we invest for $20,000, or I mean $40,000, and the only place in the country was the Midwest or Northeast. So that's what I did. My senior year, I flew to Memphis, bought a house with my dad's 40 grand, renovated it, rented it out, found a property management company, cash out refi, which is like the BRRRR strategy you hear today. That's what I started doing. Graduated in May. By December, I had 10 single family homes in Memphis. And then after that, I just kept doing that, kept doing the BRRRR and growing the family portfolio. Eventually started selling properties out of my portfolio to friends and family because people started reaching out to me, hey, how can I invest out of state too? Here's the finished product, just buy it, here's the bank, etc. That's what started the turnkey company we have today, which we do over 100 homes. We did that for the last 2 years, and we started taking that cash that it was building and using it to buy a multifamily product like this in the same exact markets. This deal was funded completely by ourselves. It wasn't a syndication. It was my own deal, etc., etc. All right, let's get it started. So this is the building as soon as we bought it. These are the marketing photos. The deal was off market. A lot of you asked how I found this deal. So the way that I got it was all of last year, I went through LoopNet. Every time a new building would come up, I took the broker's name and phone number, put it in an Excel spreadsheet, and then followed up every 2 weeks. Now I have a CRM which auto follows up and auto emails or texts or whatever, so you can do that. But just don't look at the stuff on LoopNet, just scrape the agents. That's what you want. And so I did that every 2 weeks for 9 months straight. I emailed this guy on Wednesday, Thursday morning. I call him on Wednesday, and he's like, yeah, I have a deal that matches that exact criteria. Thursday morning, he sends me an email. It's like 3 lines of text. It's like, the rents on this property are this, the expenses on this property are this, the unit mix, and then it was like shitty photos, like worse than, like out of his car window kind of photos, you know, it was really bad. And it was 3 photos, and he's like, the seller won't show any financials until you make an offer. And so I was like, okay, well, I'll do what I, submit an LOI for $1 million, and got the thing under contract, and then we got the financials, and then, I started underwriting the deal. Luckily, the deal made sense after all, and we ended up closing it for, I think, $985.
Can I chime in real quick on your thing? So one thing you're gonna realize coming in is that you're not gonna have all the answers right away to get into something like this. But one thing that a lot of high-level people is get it under contract first and then worry about the problem solving later. A lot of people don't take that dive into the first deal because I don't think I have my ducks in a row, I don't think this, but the numbers do work out, and at the end they pass it by. And so you take the deal and then worry about the other stuff after. Raising the capital, you got a little time, but you gotta, pedal to the metal. People tend to work better under pressure.
Yeah, to go back on that, I have a 24 unit building half a mile away from this building right now, under contract for $1.5 million, and I just asked for a $400,000 price reduction due to contingencies, and if he says no, I back out, get my earnest money back, and just keep rolling.
It's as simple as that. If the deals don't work out with the numbers, back out.
All right, so let's get into a case study. Disclaimer. The Monroe Apartments. All right, so some property information. So that's the address. It's a 20-unit building made in 1964. The average rents when we bought the building were $560 per month. The property was 100% occupied, which helped, and all the tenants were actually month-to-month leases, which helped as well. That's a benefit of investing out of state, is that if tenants are month-to-month out of state in these markets that we're investing in, if they're month-to-month, you give them a 30-day notice, and they can either take the higher rent. So we would go to these tenants who are at $550, $560, and say, hey, you have 30 days, the new rents are $750 per month, sign it or leave. And so we just started doing that that's how we cleared out the units to start renovating the units to clean it. So property was 100% occupied, bought it for $985. Down payment was $335. Total renovation costs were $210. So the total amount of cash to buy this thing and renovate it was $545,000. And there was a couple of things we wanted to do when we bought the property. One was increase rents. So of course the rents were $560 per unit. The market for those 1-bedroom, 1-bath was $725 at least. Create a community. So the exterior of the building hadn't been maintained at all. He didn't renovate anything on the exterior. All he did was the interior of the unit. But as you'll see, like, you're pretty much walking to go and look at a showing of a unit. The unit looks great, but that walk from the parking lot to the unit was horrendous. And you would walk under these handrails that were like rusting down and about to collapse. Nobody's gonna rent out your unit, buddy. So he renovated all the units, but didn't spend the money on the exterior building that community. So we wanted to do that, which you'll see, I have a video that I'll show you. Third thing, incorporate professional management. So the manager was like, imagine an 80-year-old guy with overalls coming on the first of the month to collect your rent every single month. That's what this guy was.
Hands-on guy.
Hands-on, he knew all the tenants by name, etc. So he was really hands-on on the building. And that's great, but it's not a long-term thing that you can do. So we incorporated professional management, so now tenants can pay through their phone and pay online, and pay, nobody really wants to deal with their property manager, right? Unless there's a big issue that needed to be fixed, but nobody really wants to deal with property management. So the property is located in Midtown Memphis, B-class neighborhood, up and coming for a couple of reasons. Job growth, there's a high millennial population growth. Like for anybody who's a millennial in this room or young professional, if you were to move to Memphis, you would live in this kind of area. This would be probably the area that you would move into. There's multiple hipster hotspots, I don't know another word for that, which I'll show you on a map later. But there's Cooper Young, Overton Square, Crosstown Concourse. You can look those up later. And then the unemployment rate has gone down since 2009, which is probably a bad metric. But so this is where the building is, the red ticker. So this is where the building is. This is a brand new Starbucks, ground up. This is a hospital. This is the medical district. This is another hospital. This is a hipster hotspot with a brand new, like, I think 1,000 units. This is renovated apartment building, 250 units. This is another hipster hotspot. Lots of bars, restaurants, coffee shops. Bars, restaurants, coffee shops. This is a 250 unit, fully renovated. These are 2 new ground up construction projects, 300 units. And Memphis hasn't seen this new construction phase forever, I don't think, since the 1960s.
I think
So,
it was like along with Detroit, they just
Yeah.
one left.
So the 1960s is when most of this product was made, and now the prices have gotten to a point where it actually makes sense to develop. So where the cost per square foot to build it actually makes sense to go and sell it. And then just a couple weeks ago, there was a project right here, right behind our building. It was just a vacant land, and that's just got permitted approval to do another 300 units. So really up and coming area. This is really bad. This is really bad, but then in here you have $300,000-$400,000 homes, $200,000 homes, which for Memphis is, 4,000 square foot mansions. So why this property? A couple of things. Bought it at attractive cost basis, so 20 units, $1 million, 50 grand per unit. The property was owner managed, so we could bring in professional property management. Rents were below market by around 50%, from 560 to 750. The property was sold to us with a brand new roof, so that's one big ticket item we didn't have to take care of. It's only 25 grand for a full roof there, and the property was fully occupied, and it was month to month. So it allowed us to go in and ask those tenants to leave within a 30-day period, or just ask them for the higher rent. So this was the kind of change. This is not done yet, so I know it looks like shit. Just look the fence upwards. But this is what it looked like before. So we put in all new landscaping. These poles will be removed. We built a fence here. You can see the fence. There's like an 8-foot fence that goes around the entire property. Before it used to be this chain link fence, which was along another parking lot. So we kind of enclosed it with this huge, ginormous cedar fence. So now when people go and park there, then we put lights pointing down at it, so it's kind of their own like private parking lot almost, because nobody can see through the chain link fence. These are all HVAC units, and it looks like crap being in front of your property, so we built a tiny little cedar fence in front of it, and then we put a new sign in. Again, don't look at that. We put a new sign in as well, which the sign before was this, and it was like, this is supposed to say the Cambridge, and 1460, the C had fallen off and all of that stuff. And so this was the biggest part of the project. This ironwork was hanging by like a ½ inch of metal right here. These things were swaying back and forth. This was not in the ground, swaying back and forth. You'll see this is all water damaged and rusted and about to fall down. The same thing over here, you see all the rust that's happening. And so this was a totally dangerous situation. And so we had to replace all of this, and we built brand new landing. So this is just the middle part, then this was replaced after. I'll show you this video. Anybody guess how much that all cost to replace, I mean? 50 grand?
30.
It was $70,000 to replace the whole thing. And my budget was $25,000. Because, so my contractor crews work with me a lot, they're full-time with me. But this is a welder. So this is not just somebody who can come and do an interior, exterior rehab. So I had the interior and exterior down. When you have these special people who have to do this kind of stuff, it's kind of like a shot in the dark. I have to go and trust somebody just from a referral or something like that, which is what I did. He gave me a budget, 25 grand to do the whole thing. It was like 7 grand to do this. I was like, okay, that seems reasonable. Somebody said 30 grand, right? I thought so too. I gave him the deposit, and this is the one that was installed wrong. So this was installed, and I told him to stop working, because you see this first step? You see this first step right there? It's like this tall, and then the other steps are like normal steps. So he couldn't do math, and so we fired him, and we had to have another guy come in. And now my new bid, so I paid 7 grand for this. Then the new guy came in, he was like, it's gonna be 70,000 bucks, and we're gonna have to redo this because this is absolutely horrible, we can't even fix it. So we had to, this was the biggest thing. Now we finally have a guy nailed down. He's 3 times the price, but he does it right at least. And then let me see if I can show you. I was there like 2 weeks ago, or something. Don't mind my face, but. And so this is what was put in after. And see all the rusted shit that used to be there? So all that was torn down, and they're actually tearing it down right there. And they have like a forklift that comes and like pops the thing up. This is the old laundry room that we renovated. It looks really nice. Which used to look like a dump. And we put an AC in there because it was like a sauna. Oh. See the cedar fence? Then the next thing was to repave it, which is actually happening today. So see the huge cedar fence that we put around too? It was like 8 or 10 feet tall. All right, back to it. Okay, now this is what the units look like before and after. Just for reference, these are the kind of appliances that were in there. And it was this black and white, kind of like this, but smaller, black and white tile that goes back and forth like from the 60s. So we had to tear that whole thing out, and then we put, this is actually tile, it's not vinyl plank. Tile lasts longer. If somebody just slams and breaks a tile, great, you just replace the tile. Vinyl plank, what happens is that water gets underneath the vinyl planks, and then it starts bubbling, and then you have to repair it, and then you have to replace the whole vinyl plank, because it goes under one section, but then it spreads out. So with the tile, it's more expensive, but you do it once, you do it right, and then you just, we literally, when a unit turns over, we just go and mop and repaint, and that's it, as long as the appliances are fine. This is what the bathroom looked like, well, after we demoed it, but this is the kind of flooring that the bathrooms had. We ran the tile throughout that, put all new stuff in here, ran tile up all the way, new lights, new vanity. And so this wall was a closet, and it was really weird, so we tore it out and just opened it up a little bit. It was a useless closet. This is what the kitchen looked like before and after. Again, they ran that black and white tile stuff in the kitchen as well, and then those ugly appliances were in there. And so we put granite countertop, new black splash, all new cabinets sometimes we would paint the cabinets and just put new finishes and put new countertop. This one had the whole new thing. We rebuilt, I think we rebuilt it all and put new appliances into it. All right, so how do we do? So remember, we bought the building, the rents were $560. And we started with just a couple of units. So there was rents all the way from $400 a month all the way to $650. So the average was $560. So we went to the people who were paying $400 and said, hey, the new rent's $725. You can pay it or leave.
Let them know what the percentage of people saying, I stay or I leave.
What do you think they said? So one of them said, yes, I'll pay the new rent. And we were like, really? You're
That's
gonna
the fastest ROI because you didn't have to fix that unit for nothing, right?
Yeah.
But you get very few of those.
Yeah, so about a 30% of the people just stayed, because what we did is we first went and built the new fence, did the landscaping, started doing the handrails and all that kind of stuff. So concrete, oh yeah, I didn't even talk about that. Okay, so this was like horrible, like garden, and these were like all his little, whatever. And so we concreted it over. It doesn't look very good in that photo because we're doing construction, but now I just bought I bought two like big black iron with plastic coating on top of it, like chairs, circular chairs, so people can go there and hang out. Oh, and I also strung lights across back and
Nice.
forth, so like people can come and hang out there and eat dinner or whatever on a nice warm day in their secluded little area. That's what my objective is. But this was like totally unusable space, and to get to the parking structure, you have to go that way. So if I'm living here, I have to go walk around this ugly thing every morning to get to my car. It wasn't really pleasant. So we really opened up the area. And also my maintenance costs. And also my maintenance costs go down, because he was watering this damn thing and he had like a full-time maintenance guy maintaining this little garden box. And that guy lived in this unit. And what was happening too is when the rain would come, first of all, he didn't have gutters on his building, which wasn't smart. That's why he has this. And so there was water coming down through this planter box, and there's a basement over there underneath the ground. And that's where the laundry room is and extra storage was. What was happening is all the water was flooding through the center console, going to this planter box, and then rotting all the wood underneath. And so he had termites, he had all these issues, blah, blah, blah. So we were just like concreted over for $10,000 in solution. All right, so we bought it $560 per month in rent. We estimated $725. What actually happened for the first couple of units when we put them on the market is they rented out for $850 per month.
Nice.
So we totally blew out our expectation of what actually we were going to achieve, and we got the highest rents for that little neighborhood of any apartment building. The other people were marketing their stuff for $750, so I was conservative and said $725. As soon as our market was up, as soon as our unit was up and the photos were up, we said, hey, let's just shoot for the moon and see what happens. We listed it for $850. In a week, we got an application, tenant moved in 2 weeks later, and we were like, holy crap. All right.
For those that have multi-units, that's always a great idea to do. We've done that in our last 5 buy and holds. You look at the market rents, right? But because we kind of know what the market finishes are commanding, if you execute the rehab right, put some nice finer touches on it without breaking the bank, of course, just shoot it a little bit, try it out, and if you get no action, then just come back down on your price. But if you set the market high trend, everyone else is gonna follow suit too. So we broke a lot of rental records in some of our pockets. We were just amazed because we were just like, I had no idea this was gonna go this way.
Yeah.
But if you execute the pictures right, in your rehab, in your staging, or whatever it is you're doing, man, it's only, you're the one that's gonna set the trend, and then everyone else is gonna follow.
Yeah, no, we definitely did. And we knew we were spending more on the first unit, but you run the math on this extra $100 a month at an 8% cap rate. I mean, it's like an extra $100,000 in budget that you have for $100 a month rent. Because $1,200 a year at 8%,
Yep.
at a 10% cap rate, it's $120 grand. So your budget for a little 10 grand unit is a no-brainer now to put the highest finishes. So that, therefore, the total income was 134 when we bought it. We thought 174, we actually got 204. Total expenses were 52. There was not much change in expenses because the guy was running it really poorly at the 52. We added a little more because we had not a full-time, but we have a maintenance guy who goes and cleans and sweeps because now we have the concrete that you need to sweep and stuff like that. So the NOI went from 60 all the way to 140. So at a 140,
Can you zoom in on that page stat so everyone can see those numbers at the bottom? Or you cannot.
no.
That's right.
So to find a value of the property, you take the NOI and divide it by the cap rate. The cap rate in this market is 7%. So at a 140 new property value for $140,000 NOI divided by the 7 cap. So now the building is worth $2 million. Remember, I bought it for $1 million, put 200 grand in renovation. So I'm all in for 1.2. The building worth today is around $2 million based on that cash flow. Once I finish all the unit renovations and get all the rents done.
Remember that the more the building is generating in cash flow, that's gonna dictate your AR, or your future value of the building. So basically, what he's doing is just increasing the rents, like he said, and that instantly, you do the math on that, and you can pretty much kind of gauge what your building's gonna be worth. The banks come knocking at your door and say, how much more money you wanna pull out of this thing? So really, the goal is to maximize the rents as much as possible and increase the value of your building.
So what we expected, so normally I underwrite my buildings on a 5-year IRR or internal rate of return. Internal rate of return means it's going to be a 5% return year over year over year, year over year for a 5-year period. So when we ever buy a building, we underwrite very conservatively and we try to hit 15% for a 5-year period, selling it at the cap rate we bought it at. So remember the last slide said 7 cap? This number is conservative based on the 8% cap rate. Does anybody not understand cap rate? Just raise your hand. Oh, this is my point. So that's how you can calculate cap rate, but you can move all the functions around, right? So the one that we just did here was, if we want to get the value of the building,
Let's go back.
you take the NOI and divide it by the cap rate, so you can move certain things around.
And then real quick, guys, the NOI is pretty much the growth, your gross rents minus cost, right? Your expenses for the building, which is taxes, insurance. The net is left, and then that's pretty much where you're gonna go with.
Yeah.
So it's whatever the building is generating in income minus expenses.
Yep. And so this is also, net operating income is also before your debt service too. So let's say you bought a building and it's making 100 grand a year in NOI, and you bought it for $1 million, that's gonna be a 10% cap rate, right? Which is gonna be ridiculous. And that's before your debt service. So that's an easy way that you can move things around. So you can play with that number and kind of see what cap rates are and how cap rates work. Cap rate is the income you would receive if you were to buy a building all cash. So if you have $1 million, you buy the building all cash, you make 100 grand a year, right? That's how you get the 10% cap rate. Okay. So what we expected was a 15% IRR. Year one, you'll see it's really low, right? Because we were only making the $560 per month per unit. Year two, $725, remember, was what I expected. And make that for a couple of years until year 5, where you go and sell it, and you sell it for an 8% cap rate. So to find that, you would just take your NOI, divide it by the cap rate, so you'd flip-flop it, to get the sales price. And so that's how you get your profit number here. All right, and then what actually happened was, year one sucked. Year two, instead of getting $725, we got $850 per month. So the cash flow instead of 60 grand was 90 grand. Did that for 4 years, and then at the end of that, we sold the building for an 8% cap rate. So what actually happened was we increased our IRR by 25 from 15%. So you put in $545 to buy the building. After 5 years, you get your money back plus $1 million. And this one is you put in 545, you get your money back, plus 500. But it's over a 5-year period. All right, so this is the power of investing in multifamily apartment buildings, is the refinance. So remember I said the current building is worth $2 million, right, with my current rents, et cetera, and the current cap rate in the market. So what I'm gonna do, I bought the building in December. This December, after 1 year, because banks have seasoning periods, Freddie Mac has a seasoning period of 1 year. Seasoning period means that if you bought a property, you have to own it for your seasoning period before you can do a refinance. So the seasoning period for Freddie Mac is 1 year before you can start the refinance process. So that means the earliest that I can do a refinance is going to be this December, and the building's already worth $2 million. So what I'm going to do, since I'm all in for 1.2 in the current building, December I'm going to go to the bank. I'm going to say, hey, I want to get a loan on my $2 million building. I want my loan to be 75% LTV. They're going to do an appraisal, and my current loan amount is $650. The current cash I have in the deal is $545. So you take your 1.5, you pay off your current loan, you pay myself back, and then I'm left with $300,000 of excess cash. So I'm even over leveraging. I don't need to get this big of a loan. So in December, I'm gonna get a new loan.
This is just him maxing it out.
Yeah, yeah. I'm gonna get a new loan for 1.5. I'll get my 545 back plus 300. And I'll have a building with no money of my own money in it, making $5,000 per month, and I'll have $800,000 in the bank to go and do another building.
Sell it, right? Like, what's that trigger for you? Or are you just doing 5 years for everything? Like, yeah.
So you want to underwrite every deal the same way? Because if you underwrite every deal every different way, then how are you going to know deal A is better than deal B?
Yeah, because they have 10-year notes, 15-year notes, and then on and on and on.
Yeah, so I underwrite every deal that way, because also if the market has a correction in 12, 24 months, then you're going to be screwed if your plan is to sell it, right? And also the term you're going to get on commercial multifamily is going to be 5 or 10-year term, like you said. So you're like, all right, let's just, if I get 5-year term, which means you have to pay off the loan in 5 years or refinance it or sell it, then you're going to underwrite your deal using that, what the bank's telling you.
So for the tile floors, did you use that on the upstairs units too?
Yeah.
And then did you use like specific soundproofing or just one with the contractor's suggestion? Or?
Yeah, because I think there was subflooring and then you put it on top.
Okay.
Yeah.
And then appliances, you just go through a local vendor or?
Home Depot.
Okay, nice. Me too.
On sale on Monday.
Okay.
On sale Monday, some kind of blowout,
Yeah.
3-day weekend,
Yeah, then you buy 40 of them and put them in
and put them away.
storage.
Yeah,
Nice.
buy bulk.
Okay. And then the coin op, how long before you see a return on this? You
Never.
don't, right? You just do it
No, dude,
to make
it's
the tenants
$100
happy,
a
right?
month. No.
Yeah, it's not.
just for them.
It's not a lot of them, that's why it's not.
Yeah.
It's bullshit, yeah.
Because like, at some point I have to get them and I'm like, I don't know, it's just an upfront cost, you know?
Yeah, well, just hire a company to come and do it, and then they'll maintain it all, and they'll just like take all the money.
Okay.
But they'll maintain it, so your maintenance guy doesn't have to do it.
Okay.
That's what we have here.
Okay.
Is you do 20 tenants, you do if you do the math, we did it for the 24 unit, and it was like $120 a month. I'm like, I'm not
There's
sending
nothing,
anybody
it's
else.
not completely that way.
No, it's just like
One
something
maintenance
that's a
every 10
favor
years,
almost,
you're
or a
gone.
service.
Yeah.
And then lastly, the seasoning period.
Yeah.
So is that always a hard and fast rule? It's gotta be for a year?
No, it depends on every lender.
Every institution is different, yeah.
Okay.
Every single one.
And by seasoning, you mean like you reposition it with tenants, like new tenants for that?
No, well, it's no prepayment, there's gonna be well, you're gonna get people.
Oh,
that's
got it,
try to
okay.
refi.
So it
They
doesn't
won't even allow you.
They won't even.
Yeah, so you have to be on title for a building for X amount of months before the bank will even give you a loan.
Okay.
So they don't want you to buy a building and then 30 days later go and ask for a loan. Ask for another refinance or something like
So you mentioned the occupancy was like 100%.
that. Yeah.
So it's not a single family, empty house, you like sleeping, and when you take possession, not the take possession, but when you take the title of the whole building, you obviously assume the liability for all those tenants. How do you prepare them for the construction? How do you deal with people?
Yeah.
Do you take insurance? deal with management company? I mean, it's like face to face. I mean, how
Yeah.
do you
So there's a couple
avoid
things
conflict?
you have to do
conflict?
legals wise.
Yeah.
First of all, every contractor is always gonna have insurance, so they're always gonna protect themselves and me with that. Then I get insurance for my building, et cetera, and
Builder's
liability.
risk, right, and all that good stuff?
No, we don't need builder's risk. We just need liability insurance, then normally you get like an umbrella for your entire
Umbrella
portfolio,
policy.
which is $1 million per incident.
Per
So even if somebody comes and sues me because they got stepped on a nail or something like that, I have $1 million line that I can pull.
You're talking about contractors or the tenants?
His,
The tenants, no, contractors, no.
for his insurance on his side.
Yeah. Then the contractors have
And then they
insurance.
have the insurance for the contract.
And then property management is aware of every single renovation that's going on, and they have to put up notices and they're notifying tenants. So that if somebody does say something, we're like, we told you so, here's the documentation, and here's the photos.
And when you bumped up the rent, is there like rent control or you just like
No, there's
whatever you
no
want?
rent, no rent control.
Oh,
Oh, if you could talk to them a little bit about Section 8 and touch that a little bit.
Yeah, we don't do much Section 8, but there's no rent control on all the markets that we're doing. So that's why I'm able with 450 rents to go and ask them for a 30-day increase to double the rent to 800.
nice.
Yeah, and then let's just say there's one or two Section 8s or whatever.
Yeah,
I mean, it is what it is, but you can only increase it so much, right?
yeah, this building didn't have any Section 8s, but there is a Section 8 clause that says you can't increase it for over a certain.
For someone else.
Yeah, but you can still do once that lease is up with Section 8, you don't
Yeah,
have to
correct,
renew.
yeah, if the lease is up, then you just give them a notice.
Yeah. And so some Section 8 tenants are still on Section 8, but they're month to month, I believe. So you can still give them a 30-day notice, no matter who's paying.
It's a whole new other topic. Section 8 has its pros and cons. A lot of people like them because they're, kind of, the government's cutting you most of the check. if not- Yeah, or another people are like, it's too much of a headache, they don't take care of the units. I mean, there's people that do really well in them,
Yeah.
and then there's people that just don't even touch it, they're not.
How do you pick a property management company? And also, do you get them involved in evaluating the property in terms of rent? Or, for example, like you had the $70,000 staircase, right? If they were to help evaluate, maybe they could have mentioned something about your rehab budget. Do you get them involved in that at all, or is it
Yeah.
you just secure it and then you're like, okay, we need you to manage it?
So this property management company manages single-family homes. They manage all my single-family homes and all of my clients for the turnkey business single-family homes. So they had never done an apartment building before, but I trust them a lot. They have a lot of good people running the company. So this was their first apartment building to manage. And she's killing it. She's doing a good job. And they still did professional photos, got way above the rents that we thought. And yeah, when we're underwriting a building, we always ask, because they always have data that's not accessible to us, right? Especially if they have managed 1,000 units in a market, then,
They have good data that you wouldn't otherwise have access to.
yeah, because they can say current active leases in this zip code or in this area, pull them all up and take the average of those, and then be like, all right, we think your building is gonna, based on our current properties we're managing, we think you can get this rent, but the market's telling us this. And so they have a lot more data that you can't get on Rentometer, right? So that's something that we use property management for. For managing the construction and stuff like that, they're okay. It depends on property management company that you use. If they're used to apartment buildings, then sure. But this company was totally single-family home, so they're not used to managing those huge projects. So we hired a project manager, and they managed the entire project and all the renovations and moving contractors.
Did you, is any syndication involved in this one or you just?
No, this
buy
one was our own
it?
money. No syndication, nobody else. Yeah.
Can you explain to everybody for all the other years what syndication is?
Another hour.
Short version.
Okay, so a syndication would mean, so you buy the building. What? So you buy the building for $1 million, you put this much down, which is like 35% down. This loan was actually from an asset-based lender here in LA. It wasn't with a Freddie Mac lender. So most people get Freddie Mac loans. The issue with Freddie Mac loans, which is like pretty much conventional financing for multifamily apartment buildings. If you want to look it up, it's called Small Balance Multifamily Loans by Freddie Mac, something like that. But they have a loan minimum of $1 million. So this deal doesn't qualify, right? Because if I'm going to get 80% LTV, then the loan's 7 something. So I can't get a Freddie Mac or conventional financing on that property. The benefit of Freddie Mac is that it's non-recourse and it's 5% interest.
Yeah.
This is
Okay.
35%. This is 35% down instead of 25% down. This is a 6.5% interest, and it's full recourse. So it's pretty risky financing. The benefit is that I can now that the building's worth $2 million, I can go to Freddie Mac now after I've been on title after seasoning for 12 months, and now I can get my interest rate from 6.5 to 5, and that's the benefit of buying a building in this kind of price range. Okay, regardless of that. 335% down, 200 in renovation, so total equity is 545. So I own currently 100% of the building, right? If I put in 545, I own 100% of the building. What syndicators do is they say, okay, I'm gonna raise $500,000, I'll put in $50,000, and I'll give away 70% of the profits for the deal. So the benefit is that I manage the deal, I put in the sweat equity, I manage the whole entire project, but I only have 50 grand in the project, and I raise the rest of the money. Those investors still make a good return, 12, 15%. I handle the monthly payouts and all that kind of stuff. They're completely silent. But I'm able to, let's say I had 500 grand in the bank, now I can do 10 of these buildings. And if you look at the IRR, or the rate of return for a $50,000 investment, for 30% of this project, if I give away 70, it's probably over 100% IRR or return. So that's what syndicators do to spread their money, spread their risk, and then they raise a ton of capital and they give away cash flow and profits and all that kind of stuff for these buildings. That's what syndication is. Cliff notes. Yep.
So as it relates to crime, right? So that area in Memphis
Yeah.
is kind of like next to like rough areas,
Uh-huh.
right? Like Memphis actually has like a higher national average of crime.
Yep.
So are you good at like looking at gentrifying areas? Like, cause you know, like what was that process like? Did you go there a lot to see it yourself? Because that to me was I perceive that as a very high risk.
Yeah. Yeah, so I had never seen this building until I put it under contract and did my walkthroughs of all the units.
Oh, wow.
Yeah.
So the way he does it and the way we do it is similar in the sense that you're not gonna wait your time value, right? It's more like if it's under contract, then you go see it. Because if you're going after continuously,
Okay.
your time value is not really there until it's under contract. But again, you gotta learn all that stuff first beforehand. But if you're whipping out a lot of offers, it's because you're not seeing the buildings. We're not seeing our projects either. Until it's under contract, then we don't see it.
Okay.
So basically, in the gist of it, he doesn't see it until he actually gets under contract. And now it's worthwhile to go see it, right? Because it's a potential deal. But that's only when you're skating. If you're doing a couple at a time, it's always best to go anyway.
Yeah.
And I mean, if you want to do something closer, not exactly like out of state for your first one, then you would want to go because that's the way you're going to learn what things cost, what things look like, kind of thing. And I mean, don't get me wrong, when he first started, he was traveling a lot to go see these things. But once in a while, once you start getting the hang of it and you kind of start becoming really good at it, he's only going to go out there until it's truly under contract and escrow, and then that's when he starts going.
But of course, it took a lot of legwork to know the market, to know the
Exactly.
team. The benefit is I can get a deal tonight and I can have somebody there tomorrow morning taking photos and sending, because I have the team on the
He
ground.
has a ton, by the way, don't get me wrong, he has a ton of boots on the ground over there. He built a team around this, and it shows in the work. It's 4 years of team building. So he has a ton of boots. He has the property management, the rehab teams, the project managers. What we have here locally, he's been able to do it in different markets that he likes at lower price points that are appreciating faster. So it's more like, it takes time to build these teams, but he's at the point where, he can have someone the next day literally start taking photos. I want to see it. Send me a video. And it's there in the morning, and it's already under contract.
But you can do it too.
Yeah,
So
very
you
doable.
can
Very
build a relationship with all those brokers, follow up with them every 2 weeks. Then as soon as some deal comes up, go to Craigslist.org and hire somebody $20 to go take photos of your
And that's how it is. People they're not gonna tell you what it's like, you know? You'll be surprised.
We used to do bandit signs, and I went on Craigslist, and I hired somebody else on Craigslist to go meet somebody on Craigslist to give them the signs.
There you go, see?
And then you pay them $1 per sign to go and do the sign. Then they take a photo, and then you pay them $1 for every bandit sign. Just gotta get creative.
Got it. Okay.
Yeah.
Yeah.
Can you talk about the exit strategy? Are you anticipating, because you have a relationship with the bank, you know, okay, I'll do 1 year and this bank will fund it, or are you just kind of guessing, or because you've done it
No,
so
don't
long?
guess, yeah. They have term sheets that have all the info on it, so I just call, I called a million lenders before I got this lender in LA to actually fund the deal. So I would call every lender who, first just work with the Freddie Macs if you can get something approved there, because the interest rate's 5
It's
instead of
insanely low, yeah.
5 instead of like 7. But that's what I would do first, and I would make sure you have that refinance piece nailed down. If you're even just thinking about it, just get a Google sheet and just collect a bunch of info from a bunch of different lenders and just see what their terms are, because somebody will have a 30-day seasoning period that's,
No.
let me know if you find them.
Yeah,
But,
all day, every day.
Yeah. But I mean, so like, you may find a golden thing that you look on Bigger Pockets I've never saw before, and great, now you can use them instead of, having a super long seasoning period or interest rate. So yeah, I would just do your research and then let them know what you're trying to do and what your process is, what the numbers would look like, and they're fine with just collecting information so that you can use that for your refi later.
Yeah.
I guess when you're putting your offers out there, are you budgeting yourself before putting those offers out there, or are you just waiting to see which ones get accepted? And if you get multiple offers accepted, if you wanted to get out of it, do you just use your contingencies to get out of it?
Correct, so, for the most part, I mean, at least here in LA, right? It's 72
Yeah,
hours. It's 72 hours, I don't know what it's like over there before the EMDs do.
Oh, yeah, you can make it
Oh,
up.
so that's the quickest way to get out because of the EMP?
Yeah, you quickly analyze the deal, if it gets accepted and you forgot, because you sent the deal so long ago. And
I guess.
Go ahead.
Well, for us, for apartment buildings, you're gonna have to send in the earnest money, because normally you wanna walk every single unit, right? So that's part of your main due diligence. You can go walk the building all day long outside of it. As soon as you get in one of those damn units and, the floor's leaking or the roof's leaking from the inside, which is what happened last week when I was in Memphis, then, it's a whole different ballgame. So, yeah, budget yourself, but you still have to make a ton of offers. And you're gonna have to put that earnest money out. You can try to limit the amount of earnest money you have. And yeah, you have a bunch of ways to back out of these deals. So this deal was 30 days due diligence, 30 days to close. So I put it under contract. I had 30 days to buy a flight, set up an appointment, find an inspector, find a lender, and get all that stuff, find an insurance company. And you have to do all that within 30 days before you can back out and get your earnest money back. But you have a financing contingency too. So you can go and say, hey, the lender,
The
Yeah,
lender
get a
said
loan.
this building's worth way less, and
Yeah.
then you can't
Yeah.
finance it.
that's it.
Wow.
And so what I also did for this building was, this guy was extremely slow. So what I did is for the offer, I said due diligence does not begin until a brand new roof is put on the property and until I receive all financials. So that bought me an extra month. Because,
Most people aren't organized, it's not like they have it in a PDF, and it's here the next day.
well, because he's self-managing, collecting cash or whatever, and
Yeah.
Oh,
you know what I'm saying?
yeah.
So it bought me an extra 30 days of time to collect all that information. Because remember when he came to me and pitched it, he was like, hey, I'm not gonna give you any financials until you put it under contract. And I was like, all right, sure. But due diligence doesn't begin until you send me all of it, because I don't think you have it.
Right.
That's why you wrote me a 3 sentence message.